All right, welcome everybody to this webinar. This is a two-part series on the geopolitical and macroeconomic events that have unfolded in the United Kingdom in the last 2 weeks. We now officially have what is known as a Brexit, and now we're going to discuss the aftermath, what it means economically, politically, socially, legally, and most importantly for you as aspiring or semi to professional traders. As always, the agenda is to tell you a little bit about us, and then we're going to discuss the Brexit outcome in detail. Then we'll discuss what lies ahead and what impact the events that may unfold over the next few months will have on currencies and also other asset classes, and what steps you can take as a trader to navigate this environment, hopefully profitably. And last but not least, we'll hold a Q&A as always, where you'll have the opportunity to ask us questions. And if I've missed something, you can, of course, email support@blueskybinary.com or webinars@hotforex.com. Before I proceed, kindly observe this legal disclaimer and also the risk warning below it. Give a quick introduction on who we are. So we're Blue Sky Binary. We're an education, research, and trading group. We are a group of senior traders that researches, educates, and trades both the binary options and FX markets. We also provide 24-hour trade support and analysis to allow binary option and FX traders to trade safer. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you to help you become highly profitable currency traders. The Brexit. Last week at 6 a.m. on the 24th of June, the verdict was reached that with a 52 to 48% modest majority vote, the United Kingdom opted to leave the European Union, ending around a 43-year period of close economic, legislative, and socio-political ties with the European Union trade bloc. To the markets, this came as a negative surprise, putting the future of the UK, at least for the next year, on a very uncertain path. Close to 2 trillion of equity value has been wiped off the markets, and the UK saw its credit rating downgraded to just AA. The British pound, as some of you have participated, I can see already, in this decline has suffered a drop of around 1,500 pips against a basket of currencies. Gold, meanwhile, has risen around 8% as it's a risk-off asset. UK property companies have seen their shares drop by around 20%, with a forecasted drop in the UK market of anywhere from 5 to 10%, possibly triggering what has been a long touted for property bubble as well. It's also worth noting in terms of leadership, the Prime Minister Cameron has immediately resigned, leaving the leadership in a state of confusion and disarray. The question, of course, now is what lies ahead? There are a lot of moving parts, and I want to use this webinar to demystify some of what exactly lies ahead. From the political standpoint, the actual withdrawal process from the European Union for the UK is far from confirmed. All right, that's really important that you understand that. Article 50 under the Lisbon Treaty needs to be invoked by the UK Parliament, and then only will the 2-year withdrawal process begin. Right now, nothing has happened as it stands. It's just a public referendum. It has not been ratified in the Parliament. So PM Cameron will not invoke it himself. That is something he has confirmed. But he expects the newly elected leader, which will happen by a ballot process, to do so in October. Right? So nothing is going to happen in terms of the official withdrawal until October. Europe, however, wants this to happen immediately. The market does not fully expect the referendum to be ratified and Article 50 to be invoked. If this does happen at the end of September, early October, then there is a further downside to stock markets of around 5 to 10%, possibly more, and the British pound of another 1,000 pips, okay, which is a large amount. So if you look at a lot of the investment banks and the FX currency research houses, they forecast a downside of another sort of 1,000 pips, bringing the British pound to USD somewhere between 1.20 to 1.25. Right now it is around 1,000 pips higher. It's somewhere between 1.33 and 1.35. All right, and it's already suffered a 1,500 point decline from the 1.50 handle last week. All right, so this is really important to take on board, that the full extent of the Brexit is nowhere nearly priced in. Okay, and that will only happen if Article 50 is invoked. Now, the thing to note is that this further downside, should Article 50 be invoked, will be predominantly driven by second referendums in Scotland and Ireland. Scotland has already tried to leave the UK, but it was voted down by the public last year. However, now they have voiced their opinion to definitely leave the UK. If the UK is going ahead and withdrawing from the European Union, they want to join and be an independent state of the European Union. So what you are probably going to see if Article 50 happens is a disintegration of the United Kingdom on the northern side, right? Doesn't mean the entire economy is going to disintegrate, but obviously the parts that are wanting to leave via referendum. So that will place a further downside pressure on the British pound. Also note that if this happens, if Article 50 is invoked, it's probably going to cause a significant flight of capital outside of the UK, sending the economy into a mild to a significant recession, all right? Whichever think tank you look at, whether it's the Financial Times or the London School of Economics, the forecasted decline in GDP ranges from mild to significant, right? And this is obviously in the short run. No one here is saying that the UK economy is doomed and this is game over. The UK economy is a strong economy. However, it is a net importer, and we're going to discuss the economic impacts of Article 50 being invoked later this year. And obviously the risks are tremendously to the downside. Okay, but what you need to understand now is that companies across the UK and even in parts of Europe that have a lot of business in the UK, often up to 20% of revenues, are now going to be holding back their investment decisions, their hiring decisions, capital expenditure decisions, basically self-reinforcing the recession. If companies don't spend, if companies don't invest in human and physical capital, right, this itself will hamper economic growth. And therefore, because companies do not know if Article 50 is going to be invoked, they're just going to err on the side of caution and not spend. And that itself puts the economy into recession. So whichever way you look at it, the downside is still prevalent. Although the British pound has dropped dramatically and now it's witnessing some degree of recovery, this is what is known in financial markets as a dead cat bounce, right? And what normally happens after this is, unless there's a massive shock in a second referendum and everything goes back up, is that there is a further downside. And this can play out over the next few months. With regards to the final point on the policy and politics and leadership surrounding the Brexit, Boris Johnson, the former mayor of London, is currently the favorite to be the next leader. Okay, so that's important to take on board. And also, on that point, he was never pro-Leave anyway. He was pro-Leave to a certain degree, but he was not a staunch supporter of the Leave campaign, unlike Nigel Farage, the leader of the UKIP party, which was the designer of the Leave campaign. All right, so it's important to note that the next incumbent, which most likely will be Boris Johnson, unless something changes, is not staunchly pro-Leave, right? And so that's one sort of, I'd like to plant a flag there so that you all can see that, because we're going to reroute to that towards the end of the webinar. So we discussed the politics. Let's go a little bit more in depth in that. So currently, if you look at the opposition party, it's also in a state of total disarray. Normally, the UK functions where you have two voices being represented in some degree of a coalition form of government. And in this case, their leader, the opposition's leader, Jeremy Corbyn, he is losing a lot of support internally with his MPs. So at this moment, the opposition is weak. The main incumbency, the main party with Cameron as its leader, has basically resigned and said in 3 months he will be giving the helm to the new leader. So the entire politics of UK, the entire political leadership is in a state of uncertainty. All right, and this is likely to continue for the next 3 months. And again, in short, what this means for the British pound is that it's going to be a nightmare trading it, right? So for those of you that have enjoyed the big drop already, kudos, really well done, right? But for those of you that are looking to trade it, we would ask you to err on the side of caution. And again, we're going to get to that towards the end of the webinar. The most important thing to note is the trade negotiations with the European Union, right? The UK can most certainly survive without the European Union, albeit possibly in a lesser form of itself, right? I mean, this remains to be seen. But the main point is that the UK is a net importer. It's not a net exporter. It actually has a trade deficit. It has a trade deficit with most countries in the European Union, right? It has a trade surplus with giants like the US, but mainly because it's not really a big buyer of product and services from the US as it is relative to Europe. And on a net basis, it's a net importer, which means that it benefits more from the European Union than the European Union does from it, right? So the important thing to note is that the trade negotiations that will ensue, if it was everything down to Europe, then they should start now. But if it's up to the UK, they're basically buying some time, and they want this to happen in October. The key thing is that if you don't have a stable government, it's very difficult to negotiate properly with Brussels, right, with the European Union. And so this is something the market is very worried about. And we see that in the very strange market conditions that we're seeing now, because it is absolutely instrumental for the UK to strike good deal terms, good trade terms that are similar, if not better, because that's the main reason the Leave campaign was there, so that the UK could strike better trade terms outside the EU as opposed to inside the EU. Okay, the problem is the market doesn't believe they can at this moment. So as I mentioned earlier, with regards to the markets, the British pound has experienced some degree of a dead cat bounce. It is quite a big drop, right? 1,000 to 1,500 pips. However, for these aforementioned reasons, there is further significant downside risk to the British pound. Apart from obviously the UK being able or not being able to negotiate favorable trade terms, the bigger worry is the further disintegration of not only the UK via Scotland and Ireland, but also of a wider unravel in Europe. And some of you may have already heard talks of Nexit, which means the Netherlands leaving Europe, or France potentially holding a general election or referendum to leave Europe, also known as Brexit. And if you get a wider unravel of the European Union project, this will pose undue systemic stress on the global financial system, right? And we are looking potentially then at a crisis as bad as we had in 2008, right? Now, there is a light at the end of the tunnel. I'll say that towards the end of the webinar, but it's very important that you understand why exactly you're seeing this dismay in the markets, right? This lack of trust, this crazy volatility. Now, with regards to the economic impacts, the London School of Economics, which is a major think tank and an academic institution here, forecasts a UK GDP decline of 5 to 10% over the coming years, depending on what type of trade terms they're able to negotiate with Europe and other economies around the world. Now, being a net importer and carrying a sizable trade deficit, the UK needs Europe more than the bloc needs them. Okay, and with a falling currency, because they're not a net exporter, right? Germany is a net exporter. They benefit dramatically when the euro drops because they produce machines that the world buys. UK doesn't. And with a falling currency, this means that the UK is subject to inflation, to importing inflation, directly and indirectly. Let me explain what I mean by that, because this is a key factor. The UK, being a net importer, they buy more product from outside. Now, the direct impact of a weaker pound is that foreign widgets and parts that their machinery sector buys, or any sort of products that their production sector buys, will be more expensive, right? Because you have a weaker currency, and taking into account purchasing power, you just have to spend more of that currency to buy the same part. Okay, so that's the direct impact. And so therefore, when you are spending more to procure items from outside in order to build products and services and then resell them in the UK economy, you have to mark them up so that your margins don't drop, right? And this markup will result in prices increasing in the UK. And this is known as importing inflation because of the declining currency. The indirect impact, which is more fierce, is the fact that they just may get worse trade terms, trade tariffs, right? Or they may not enjoy subsidized trade with the trade bloc, with the European Union trade bloc, like they once used to as a result of being inside the European Union, right? So if suddenly Germany says, okay, you know what, you're not going to get associate status, we don't believe you are worth, uh, us giving you favorable trade terms because now you're outside the European Union. We're lumping on a 1% tax for this good or for that good, right? And suddenly it becomes more expensive for UK consumers to buy those products, and therefore prices go up, and that's called importing inflation. And when the economy is declining, and make no mistake, the UK economy now will decline because of what they have voted, the last thing you need is inflation, because you get economic stagnation and inflation, and that's a dangerous phenomenon known as stagflation, right? So there are a lot of worries with the UK economy, and these are some of the key kind of variables that the market is still assessing and weighing. Now let's discuss the legal framework. How does this change? The UK is a financial services powerhouse, right? And this is a known fact for the last, I would say, better part of a decade, maybe even more. And the main reason is you can attribute this to its light touch regulation. It's become the hedge fund and listing central globally, replacing New York a long time ago, especially after 2008, as the financial capital of the world. Now, after Brexit, London and UK's legal competitiveness is threatened in a big way. Disentangling the UK from the EU legislature will take years to complete. British competition law and merger control are part of an integrated system with the EU. The Brexit could tear that system, leaving the legal status of agreements uncertain, right? Literally company contracts, intercompany contracts between parent companies, subsidiaries, and extra company contracts between companies that are in UK and Europe. All of these contracts potentially are now facing uncertainty. Equally importantly, favorable tax terms, such as avoidance of withholding tax intra-group for companies that operate subsidiaries in the UK and across the EU, may now no longer be possible, right? Actually hurting the bottom line of companies. As for banks, many big banks have already begun to take action to shift some of their operations out of the UK to fledgling financial capitals known as Frankfurt and Dublin, right? And this is basically because the city, the way it's headed, is set to lose its passporting privileges that allow institutions to access the EU single market, right? And this has impact for brokerages as well, right? This impacts us as FX traders as well. And I'll get to this towards the end. So just to give a quick recap, because there's a lot, this is a dense webinar. We've gone over the politics, we've gone over the markets, the economic impact, the legal impact. Now let's discuss the social impact. A major reason the Leave campaign wished to exit the EU was immigration and the large burden the UK has as part of being under the EU. Outside the EU, if the country still wishes to trade with the EU under the same favorable trade terms it enjoyed under the EU, it would need to be open to free labor mobility, right? That's been a big plus of the European Union project, the ability for workers in any country part of the EU to go and work anywhere they want and contribute to that economy. The 3 million EU nationals already in the country, in the UK, are likely to be allowed to be stayed, but that is still an uncertainty, but the likelihood suggests that they will be allowed to stay. But the situation is less clear for those who move to the UK between now and the final divorce date, okay, even though Britain is still currently an EU member. Meanwhile, UK nationals living elsewhere in the EU fear that many of the services and privileges they enjoy, such as easy access to the public health service and pension portability across countries, could come under threat. And this is a big problem, right? This is a serious problem. So that's it for what lies ahead, okay? Those are the moving parts. That's the extent of moving parts and then some. We've gone over the major ones, right? That are what we call known unknowns. We know they exist, but we don't know the outcomes on them. And as long as these exist, right, in the market, you're going to have difficult trading conditions, right? And we're going to give prescriptive guidelines on how you as FX traders can navigate this. And this applies to binary option traders as well. But what does this actually mean specifically for currencies that a lot of us trade? So here's the impact on the FX majors. The euro, and you can go back to our previous recorded webinar before the the vote and see how our predictions played out to see. So euro, for example, the euro is a risk-on asset. It always has been. And since we are now in a decisively risk-off mode, right, investors are parking money into yielding assets, low capital appreciation opportunity, low risk, cash as well. We're in a risk-off mode. This also means investors are not going to be buying riskier assets, and the euro is a riskier asset, and therefore further declines are possible. And it already declined, right, significantly since the announcement. As for the US dollar, given the developments in the UK, it's unlikely the US Federal Reserve will be able to continue its rate normalization. And we have been talking about this for almost 12 months now. For those of you that have been on these webinars, we are firmly non-believers in the ability of the US Federal Reserve to raise rates so quickly, given how much turmoil and geopolitical uncertainty and now economic uncertainty there is around the rest of the world, right? So we believe this event is most likely going to push back that rate cycle, and the dollar's already dropped to price some of that in. So while the greenback has some haven elements to it, and investors tend to buy it when times are tough, and times are going to get tough, we believe there's still weakness in US dollar as well, right? Maybe not as much as relative to these other currencies, especially the British pound and the euro, but certainly relative to haven assets like Swiss franc. If you're going to buy safety, you're going to buy gold, you're going to buy the Japanese yen, you're going to buy the Swiss franc. Dollar is not exactly the place you're going to jump to, given the own set of own problems the economy has there, and especially we are looking at potentially, Donald Trump being the president in the U.S., which potentially poses some degree of further downside risk to the markets. So let's talk to let's move on to the Japanese yen. The Japanese yen, as I mentioned earlier, is a haven asset, right? It's an ex-growth economy, broadly speaking, but it's a very stable economy. So its currency is normally a safe mean for or measure of store of value and a stable store of value. So investors tend to buy it when there are tough times. Now, the UK leaving EU is bad news at first, and hence the Japanese yen may experience ongoing strength, and so would the Swiss franc. The British pound has already lost 10% of its value versus a basket of currencies, as we discussed earlier. And with near-term risks to the downside, it could lose another 5 to 10%, especially if Article 50 is indeed invoked in October. Okay? So that's kind of the tough environment. It is summer. Summer always gets tough, and this summer is going to be a bit more trickier because of Brexit. Right? But these factors are out of your control as traders, and there is no one to blame for this, right? And you can trade profitably in these markets, just means you need to jack up your risk management, and you need to really keep your stops tight, dampen your duration, take on no duration risk. And again, we'll get to that towards the end of this webinar. But before we do, I'd like to present our opinion. So this is the opinion of Blue Sky Binary, not Hot Forex at all. Right? This is specifically Blue Sky Binary's opinion. And we're still sticking our necks out there, right? So we have been firm proponents of the Remain campaign. And we actually believe that although this initial referendum was a close win, ultimately, we do not believe it is probable that Article 50 will be invoked. And that 11th hour solution will be found with or without the second referendum. Even if there is a second referendum or there isn't, we believe that there will be an 11th hour solution. And the reasons predicating our belief are the following. The economic impacts for both the EU and especially the UK are negative to dire, right? After segregation. Both parties get hurt. If the UK leaves, it will itself see some degree of disintegration, as Scotland is surely to leave. Most likely, that's a very high possibility, and possibly Ireland as well. Also, the UK may lose its competitiveness as a destination for property acquisition and speculative capital owing to its former accommodative stance on regulation and taxes. Do not underestimate the capital's attractiveness, London, where we're based now, as a hotspot for speculative property investment and speculative hedge fund capital investment, owing to its lax regulation, yet amidst a EU-regulated environment, right? And all of this stands to be threatened. Last but not least, if the UK does leave, a wider unravel of the EU project is possible. Germany, France, Spain, none of these countries want that because they themselves will take a hit. And this, if it happens, if the EU unravels, will pose a very grave risk to the global financial system. Okay, and all these economies are still reeling from the events of 2008, 2009. 2008, 2009 just seems like a few years ago, doesn't it? It literally seems like it doesn't seem like it was 8 years ago. And no real economy has really completely recovered from it, right? Apart from the US, one could argue, but even their interest rates show that there is some trepidation, right? So that's the first reason we don't believe a Brexit is going to happen. We don't believe, even if Boris Johnson comes into power, he's actually going to invoke Article 50. But this is our personal view. And I want to stress again, this is not the view of Hot Forex, this is our personal view. The second reason is no prime minister, especially Boris Johnson, would want to be the overseer of this unravel, right? The loss of the UK competitiveness, losing Ireland and Scotland, possibly causing a global systemic meltdown as Europe unravels. They don't want to be known for that in history, certainly not under their own incumbency. So, in our view, most likely negotiations with the EU are likely to result in a halfway solution, addressing UK's dire immigration burden, which we, by the way, believe is a problem, right? Immigration is a problem, and it is an unfair burden for the UK, given the numbers we're looking at, right? And the Remain camp are certainly wrong on that, in our view. They're right on a lot of other things, but they're wrong on that. And the answer is to address that, and it can be addressed. And why we believe there will be 11th hour solution is that history shows us that this is how the European Union operates. This is very similar, this referendum that we had in the UK where Leave won, is very similar to the Danish referendum, the no vote of the Maastricht Treaty in 1992. It's very similar to Ireland's no vote of Nice in 2001. Or Lisbon in 2008. Right? So historically, European Union members have been naysayers. They have voted down certain key treaties in the European Union, and then there have been negotiations, but none have left. Right? Now, obviously, UK is much bigger than Denmark. It's a bigger contributor than Denmark and Ireland. But precedent shows us that the risk of unravel and the consequences are just too dire. And we believe a simpler answer is not to invoke Article 50 and to spend the next years renegotiating all the trade treaties with all the countries around the world and rebuilding UK's trade framework and legal framework and political framework for what? Right? The answer is to address the individual problems like immigration. So we actually believe this won't happen. But of course, time will tell. Whether we are right or whether the market is right or whether Brexit happens or not, time will tell. The answer is the situation is not going to get easier. The markets are not going to get easier, at least for a few months. And so this is what we suggest to you, how to navigate this complex situation. You brace yourself as market conditions have become very unpredictable and with volatility likely to continue to spike at least till September, right? That's when you're going to get the new incumbents, the new leadership in the UK. And that's when the decision will be taken whether to invoke Article 50 of Lisbon or not, right? So until there, and mind you, we're just at the end of June, so there's a whole of July and August to go, there's going to be a lot of uncertainty. Trading short term, reducing the duration is favorable given long-term positions can come undone owing to headlines, right? Press releases, headlines, headline risk, news risk, all of this can trigger your stop losses. So short-term trading, scalping potentially as well. Reduce your leverage and your trading margins, although we're seeing now across the board brokerages are returning their margin requirements back to normal, pre-Brexit levels. But it's worth noting that, as I said, there is a further risk to the downside, material downside risk to the pound. So there is no telling whether brokerages may get scared once again and raise their margin requirements to hedge their risk at some point in the next 2 months. So just keep that in the back of mind. You should reduce your own leverage. Also note that correlation has increased in the market. Did you notice how on the day of Brexit, haven assets like Swiss franc gold shot up, Japanese yen shot up, euro, British pound, all the risk on assets fell dramatically, right? This is called correlation. Don't trade correlated, trade one position at a time. And last but not least, watch the spreads. Keep an eye on the spreads. The spreads are tricky. They are a major moving part, especially in these market conditions, and brokers tend to protect themselves more in these environments. So you may see sometimes on the margin some crazy spreads. Not always, but it's just worth taking on board. Okay, so thank you for your time. Now it's time for questions.